G'day everyone, this is Oinka here. Welcome to Investor Journeys, where we chat with everyday Aussies and seasoned investors about their property journeys, the wins, the stuff ups, and everything in between. Whether they've got one property or a whole portfolio, we dive into how they did it, what they've learned, and what their journey's been like so far. No fluff, just real stories from real people. So let's get stuck in. G'day everyone, welcome to the IJ podcast. Lovely to have you here. This is actually our 10th episode, so thanks for sticking in, and really glad to do this podcast and share stories with everyone. And I've got a very special guest today. He's very well known in the industry, and runs a huge Facebook group, and I think now it's over 80,000 people, called Oz Property Investors, with his co-partner there, Joe, great buyer's agent as well. I don't know how he does it, dealing with, all sorts of people and everything, but, I'm in that group and I see the contribution he provides, but, there's a whole lot of other things that this guest is, part of, and, really welcome to have him here. So welcome, Jeff. Thanks for joining on today.
No, I'm excited. It's really odd to be on the other side of the mic. I have done it a couple of times, doing it a little bit more now, because I suppose I love your passion, I love your energy and your enthusiasm. I remember back listening to podcasts in 2010. Your podcast reminds me of all of that. It's the authenticity, the transparency, and there's not so much of an agenda. There's not 14 advertisers, which is fine. I respect that people have to run a business, but no, very excited, and hope I'm going to share some value with your community, share some things I've not ever done before, and even my income to build this portfolio. So I'm going to say you're one of the most underrated podcasts up and comers. You have people like Ashley Goodchild last on your couple of episodes, and also the first episode as well. People need to listen back to that. The Mums and Dads Investors. So I've listened to a couple of episodes and love your work, mate. So keen to have the chat.
Very kind words, Jeff. Look, it's a very authentic podcast. I think back in the day, I used to hear all these stories, and they seem to just have disappeared through commercialization, whatever it is. I want to bring it back. So yeah, really keen to hear unpack people's stories, and I think it's great to have people like you who, like I said, are quite well known in the investor industry, and especially in Australia, and just get behind the scenes of their own portfolio. So I'm really excited from what you've just said that you're going to unpack a few things that people don't know. So tell me about a little Jeff. Where did he grow up? And, did you guys have much of a discussion about money through the family? How many siblings do you have? Do you guys interact with the wealth and money in that respect? Tell me a little bit about that.
Yeah, so it's interesting you're interviewing me on today. It's one of my parents' birthdays today, so it's sort of I was reflecting upon this a lot, and in the lead up to the show. For me, I grew up in Sydney, very working class, and I suppose to me that's what drove me to really want to understand where I wanted to go, and not get to a situation where and no disrespect to either of my parents or my family, or I really respect what they did. Money wasn't a pure conversation. Dad wasn't really an investor. Look, they split up early days, which is probably for the best. But at the same time, it was raise a single child to a single parent, and she sort of raised me, which is great. There's a lot of love in the household. She owned her own house, multiple houses in Sydney. So for those listening along who know sort of Canley Heights, we lived there next door to Canley Heights Public in that sort of early, till the 2000s. She sold that for just under 200,000. You're now sort of seeing values of about 1.2, 1.3. So that to me, that finance strategy, but also just the knowledge and the community and things such as you're doing here is really drove me to sort of unpack. I went down the path of the Mr. Money mustache,
Oh, yeah.
which the financial independence, retire early. A lot of people like Rich Dad Poor Dad, yeah, that was there too. But I was really driven to understand these people went to extreme sort of not scarcity, but extreme savings models. And that was, and my I reflect back to my first property investing seminar, which I think was seminal. And it's not that it was DHA. So I didn't do a DHA, Defence Housing Australia, back in 2010 at the Blacktown Workers Club. So money wasn't really talked about, to be very frank. And I was the first in mum's side of the family to go to university. So, and that to me, I didn't have that mentor. I didn't have that big 80,000 plus property investing community. I didn't have the uncle, the auntie who had that wealth. It was sort of like, okay, you sort of roll your sleeves up and make it happen, and sort of, yeah. So that's my upbringing through conversations.
Yeah, very, very common theme on this podcast is people coming from humble beginnings, and it sounds like you're no different. Yeah, look, it's one of those things where you look at your parents who, don't come from a huge amount of wealth, and same like me, very middle class, and most of my culture as well. And you just sort of see the habits that they form, and I
Mm.
think that's what gets ingrained in a very, you know, investors who do very well. It's the habits that they see and incorporate into their lives. I think, not to generalize, but you get people who get handed down a whole lot of stuff. And this is just my opinion, but they get handed down, all sorts of money and wealth and, anything they want. And they sort of take that into their adulthood without really understanding how to make a buck because things got handed to them. So I think it's a very common thing that we see in the investor community. So, props up to your mum. I mean, obviously, she got into real estate sort of fairly early, and sort of may have somehow subconsciously got into your sort of character there. So yeah, really interesting to hear. So then
I
what? Yeah, you go. Yep.
What I was going to say just quickly, the thing that really hit home for me is that she let so much wealth in for property sort of slip through her fingers because she was buying and selling every time. And knowing what I know now as a broker, and even sort of as an investor, you see people they'll leapfrogging. This is the 2000s, so and you can still there to some extent you can do that, but it was that frustration, that sort of pain point that drove me to want to sort of figure out, well, what is that wealth equation? How does it sort of get unpacked? But you go on to yeah, let's unpack further.
Well, I think, yeah, there's I think in people's circumstances in life, there's sometimes a need to sell without them knowing what that opportunity cost is. And perhaps, everyone's got a different story. And look, I know people have sold at the right time for their life circumstances. Now, obviously, those properties have likely doubled, tripled from there on. But I think at that point in time, that's what made them who they are. And they may not have got through otherwise. And especially with single parents and all that kind of thing, I can completely get it. But tell
Great
me, so
mindset.
now you're growing up in Sydney. What's next for you in terms of the investing world?
Yeah, so it's sort of the reason why I wanted to get investing or why I wanted to start is the concept of the 9 to 5 grind because I had this little bit of a chip on the shoulder. So I went to primary school and then went to high school and went to a very working class. So I was in the sort of suburbs. We moved out to Western Sydney, Mount Druitt sort of way. I sort of get a bit of yeah. It's not wasn't the burbs of Mount Druitt, but it was close there. So I was going to and I saw what was going on and versus some of the realities of I was mixing with some people who had a bit of wealth and had some families who did that versus people who didn't. And it didn't, funnily enough, the people that didn't have anything also had fantastic sort of family. So it didn't, it sort of, there was that dichotomy between those two things. And I realized a big pivotal point in my upbringing was going to a selective 11 and 12, which, and I won't sort of tell the whole blow by blow, but it was business studies in and shout out to Mrs. Ros Kennedy but yeah, that was to me I started to learn the mechanics of what this was sort of early, just before the GFC. So I was and that to me sort of really lit a fire under me. I was like I've started to think, okay, I was always a little bit talented at school. I did pretty well in HSC and even school certificate, but there wasn't that direction that I wanted to go. I was interested in history, but business sort of said, okay, in economics and understanding that. So I said that then sort of drove me to wanted to work in the corporate. And you see these people and they get held out. They have these big salaries and these fancy cars, and that was the dream for me. So I then decided, okay, I'm going to get a graduate program somewhere. So I applied for the big four accounting firms. Didn't get one of those. I got the ATO graduate program. Fantastic. That was great. And then I decided to move into the corporate world, the enemy or the dark side, whatever you want to call it. And I wanted to be a financial planner. And so I started to read people like your Pete Wargents, and I really have a lot of respect for a guy like Pete and Steve Ignite. These people are. I had a coffee with Pete probably 2013, 2014, but even Steve Ignite was mentored sort of through him, and it was. I started my property investing journey just before I met or around the time I met some of those people. But I thought I wanted to be a financial planner because I wanted to add value to people's lives, and money was this big sort of mysterious concept to me, and I wanted to really unpack it. If it's something, it's like if there's a sport I really want to tackle, I'll go really deep in researching it. So I don't know if I'm answering your question about how it all got started, but I can go a bit further onto property side of things if you'd like.
Well, you did, you do, you did, and in my opinion, it sounds like your school days, or at least your later years in school, had a real influence on your mindset. To the point where you were almost, it seems like, obsessing about this whole economic and money situation. You want to learn more, is what I'm trying to say, and that's amazing. And I think there's one thing about getting a graduate job and going down that path, but there's another part of it where you've actually starting to mix with some of these amazing, mentors and professionals in that industry, where a lot of people don't do that. I feel like they go through the 9 to 5 grind, come home, that's a day, go back. But you're going out of your way to learn from some of these giants in the industry. I do know Pete Warden, and I do know Steve McKnight. And yeah, that would have had, I'm sure, even a bigger influence on your path outside the whole sort of graduate program that you went through.
Yeah, definitely. And that's sort of, then you start to mingle in those. They say the average of 5 closest people you hang around with. It's a little bit cliched, and it's not to say if you're hanging out with somebody at the pub on a Friday night, it's not to say completely cut those people out of your life. It's then sort of saying, okay, what else, if you want to get to the level, new level, new devil, like, so if you're in that level, then if you want to get to that next level, it's what do you need to, what are the types of conversations, what kind of rooms do you need to be getting in? And it's really hard to get into those rooms because, and I have it as well. People reach out to me and they ask me questions. They ask me 40 questions. I'm like, I'd love to, I'll do my best to help as many as I can. At the same time, I've sort of have a family, have also all these restrictions, but just keep, if just a little bit of a nugget for people at home, keep asking those questions. If it's not the first person to speak to those 5 or 10 people. Just keep reaching out, and eventually somebody. That's what I sort of, and that's how I sort of advanced myself in my career. I got to sort of working at 3 of the big 4 banks, and for somebody, and like myself, I said, well, how does somebody from Western Sydney never have anybody in? How do I get in these rooms? It was just through having those conversations. But we should probably talk about some property, I imagine.
Well, I think it's really important. You took the words right out of my mouth. I think if the listeners are tuning in and wanting to get better at something, whether it be property or wealth or whatever it is, get out of your comfort zone, get out of the 9 to 5 job where you're talking to other clients, and talk to people in that industry who are doing extremely well. And I don't think it goes just for this property industry, it goes everywhere. So that's a huge nugget for everyone. But yes, let's talk about your property journey, mate. What was your first one, and what were you thinking at that point in time? And when around was that?
So they always say you remember your first, and this one I will never forget this one because it took me 2 to 3 years, and you're like to pull a trigger. So I missed out on the Sydney boom. Well, not missed it, but I didn't have that influence in those networks around me. So 2012, I started looking pretty seriously around the Mount Druitt area. I let's say, spoiler alert, I didn't buy in Sydney, unfortunately. Otherwise, I might be a decamillionaire, maybe not a decamillionaire, but no. So what I did was, I was taking my mum along to the open homes, and she was like, "Oh, are you sure you should stretch yourself to that 300, 400K?" And people were thinking 3 or 400K because that was around my borrowing capacity. But eventually I said, analysis paralysis. And I see this day in, day out now, speaking to people. It's like, oh, do I buy Brisbane? Do I buy Perth? Has it peaked? Or do I need to go to Melbourne? And they just sort of turn their wheels. And I did that myself. So, and this was 10 years ago, but 2015, I eventually said I started interviewing some buyer's agents. So first one was a buyer's agent. And look, it was an okay experience. But yeah, there's some really good buyer's agents, and there's some less than good operators. But as of any industry. But I bought that through a buyer's agent up in Brisbane, and Brisbane, I was talking about Brisbane since 2012. Brisbane's going to boom. And I suppose there wasn't the proliferation of data, but it was in a suburb, north side called Zilmere, and it was a townhouse, and it was 334,000. And for me, I went in with a brief saying, okay, I want capital growth, but I also want some cash flow. So you have this conversation, I'm sure, day in, day out. I do as well. It's like, where do I buy? And what's the brief? And you probably get the answer: cash flow, capital growth. So that's what it looked like. And I'll tell a story or two about that one. But yeah, want to hear your insights on that cash flow versus capital growth, just briefly.
Well, I will tell you what I think. But 2015, that probably wasn't many buyers agents around that time.
There's a few. Like I had a chat to those masquerading buyers agents. I don't want to sort of throw anybody under the bus, but really understand and I see this stained out in Oz property. It's if somebody's getting paid by somebody else to provide you a service, just be really cautious of that. And most operators are transparent, but you just really need to understand where you're handing over the keys of financial future. But I interviewed some of those, and I just said that didn't quite smell right to me. But there was a few. There was guys like Pete. There was the Right Property Group. They were running those right on track. And not to plug too many other service providers, but that was really fantastic. That's how I started to meet people like Jeremy Inazelli, my accountant. Now, and he was just up and coming. So there's a few around, and it was really difficult to understand. There wasn't the resources out there that there is now. And whether that be yours, there's so much information out there, which is good and bad. So maybe it was good there wasn't, but there were some interesting conversations that just didn't feel quite right for me. I went with the one that sort of started to vibe with me. In hindsight, I probably should have asked a few more questions about that strategy, about what it all looked like, but that was okay. I needed to pull the trigger and make it happen.
Yeah. Well, to answer your question, capital growth versus cash flow. For me, capital growth, it's a famous saying. Capital growth gets you out of the game. Cash flow keeps you in the game. So for me, it is extremely important that unless your borrowing capacity is so low that you can't get into some of these high capital growth properties, it is very, very important to start with that early, because at the end of the day, you're trying to optimize the amount of growth you're going to have in your portfolio. And so you want to be able to get these real big rocks in the jar right at the start of your portfolio, not right at the end when you're trying to get out. Trying to get that, give it time, go through a couple of cycles at least, and then use that growth to either leverage into cash flow investments later down the track through investments. But that needs to sit there for at least 5-10 years, right? At least 10 years, in my opinion, depending on the cycles and when we get in. But that's my personal opinion. Growth is key. You won't get any income from just buying cash flow properties. You need to leverage into the capital growth. Now, cash flow can be a variety of commercial and all those other type of alternative investments, but to be able to leverage into residential early and get that growth, that's what's key. So knowing I do know Zillmere, because that was one of the areas I was looking at, I think around 2019 when I started investing in Brisbane myself.
Great timing.
Yes.
Timing, yeah.
I didn't quite get into Zillmere because my borrowing capacity wasn't that high, but I got into Strathpine. But that's pretty much doubled in money.
No, Strathie, yeah.
Yep, and I got into Ipswich the year after. So I know that market quite well, mate.
Yeah. Mate, I wish, to be very frank at the time, because you could probably purchase a house around that sort of around 400, which is now, and we'll talk to that houses, we could talk to it, but we could talk about so many things. Because I did the capital growth on all of my properties, and it looks like that townhouse had performed eventually okay. But the story, which sort of I heard in Ashley's story last week, she had some trial on a couple of podcasts, the trials and tribulations that she went through. So I had my first tenant move in, and a couple of days after, they just said, I can't live here. So they literally just vacated a couple of days after. So this is my first investment property. So, and for me, you ask about the insights and the lessons, there's going to be stuff, and I see it a lot as well. People say, every third week there's a tenant request. To expect in the first year, you're going to see 5,000 to 10,000 in repairs. Luckily, mine was pretty new, so that didn't. But it scared me a little bit, because I said, well, wow, this person said that, and I bought with that mindset of buying to the train station. I bought with the city mindset, which. Yeah, so for me, it was a bit of a harrowing journey to buy that first. And yeah, eventually we got the tenant, where they'd sort of sit it out for a couple of weeks. And yes, the bond was sort of their backing, because they knew that they were on the hook until. So it's where, and then I learned throughout that first property, the property manager wasn't managing it to the level that I wanted it to be managed to. And you only realize that through sort of experience, I suppose. But make sure you're asking those key questions. Get in the property forums and not necessarily take it for gospel, but really ask those questions, and just be a little bit inquisitive on your professional team. Like, trust the team. Trust but verify is my kind of mindset now these days, and understand what's going on there.
What rent were you getting in at the time?
350.
Okay.
And it stayed at which I thought was pretty good. Yeah, bought it for 334. The thing that I didn't realize, and this is how green I was, and I suppose, and now people can get a little bit analysis paralysis. So it was built in 2009, so townhouse. There was a lot of potential supply coming on in that market. You probably know this very well. There was also, so the person who sold it to me bought it at 350. So this was 6 years on. And I was sort of tracking that market pretty closely. So then I, in 2020 or 2019, just when you were looking around there, you could have picked up that same sort of property for around the same price, maybe even that 340, depending on what it was. So fast forward, and then you saw it almost doubled. So 60, 70% with the COVID sort of boom. But yeah, you could throw data around Brisbane, most assets. But it didn't start moving till about 2022. But anyway.
Yeah. Yeah. Okay. Yeah. Look, I know that market quite well. Was there a body corp on that one as well, or was it
Yeah, pretty lean. It was like
okay?
$200 or $300 a quarter. So
Probably
because
covered
it
your
had,
insurance. Mm.
yeah, it was fairly new, so there wasn't a lot of maintenance. There was that sinking fund sort of there available. Which is, if you're going to buy body corporate, make sure that's the only ever. I mean, I have owned some development properties which are strata, but that's the only one I bought without the intention, without the sort of development play. But it's just interesting you say that because yeah, a lot of people, they don't factor this in. They don't ask those questions. I didn't even actually know that I needed to register with the body corporate to change it over because my solicitors didn't even do that for me. So because I was like, oh, I probably should be getting a bill for this. So I called up, I found out the company that was managing it, and I said, oh, is there a reason I'm not getting the strata bills? And they're like, oh yeah, actually, we've still got this other person listed as the owner. And so I was like, oh, okay, could you flick that over to me? So it's just these kind of things that you don't think of.
Yeah.
Um, but yeah,
Thrown right in the deep end, mate. But look, at the end of the day, like you said, probably performed after some time. There's certainly worse investments you can get into, but I'm sure there's a whole lot of stuff there that you've just mentioned, which people could take away, especially from their first property. So
yeah.
then where to from next?
So it's interesting because as I said, it actually kind of just treaded water. So, and this is where you're using the broker. And so for my first, I use the more, not creative, but the more sort of inventive way. For some people, it's the guarantor loan. So I had probably 50 to 60,000 in my back pocket. And I was very fortunate to have the Bank of Mum or Dad, or Bank of Mum, Dad, yeah, another story. But yeah, Bank of Mum, who sort of backed me and said, look, I'm happy to help you out with this. You keep your money in the back pocket. And it was very lucky. So I was able to then, because I wasn't seeing any growth, and you buy your first property and you just think, oh, it's going to go up by 30% in the next 12 months. That's not a normal property market. So yeah, and if you're sort of picking well. So next one was in 2016. That was in sort of in the Newcastle region, an area called Tanamba, which you probably don't necessarily, you might know it, but this was, I sort of realized that I probably wanted to buy a house. But so I had that deposit there. I was able to put in my sort of 10%, 11 or 12% with LMI, which is a sweet spot. The 88% it still is. And yeah, I sort of was in for about 40,000. I was able to save up a little bit more money. And that was for purchase around that 300,000. And it was renting. It is my best performer. So I've just got the numbers here. Originally, it was renting for, let's have a look. That was 370 initial rent. So initial yield on it was about that sort of 6.5%, 7%. And let's just have a look. So capital growth on that one has been my best at 13.8% year on year since 2016. So, and yes, COVID, that sort of situation helped that. So that was the next one. So after that, look, I suppose you could say, what did I learn? I didn't sort of go so much. I started to say, well, I need to understand what are the drivers of capital growth. And I sort of saw the ripple effects. I missed the Sydney boom, but I said, okay, Wollongong and the Central Coast. And Wollongong and Central Coast had already started to go through a lot of their growth cycle. But I looked a bit further out and I said, okay, it's interesting, 300,000. I'm like, this is almost a no-brainer, like 300K, and it's renting at 6.5%. And it didn't it saw a little bit of growth and then just sort of plateaued a little bit. And then COVID really accelerated that. But yeah, that was my next.
I mean, look, I actually got one of my guests, Supreme, in the episode, I think episode 4, who bought in Newcastle around that time, and that's been an amazing performer. So that's props out to get into that market at that time. Did you buy that through a buyer's agent, or was that on your own this time?
So I had a bit of assistance with. I did it mostly myself, and then I just had sort of some experts on the ground doing a bit of sourcing for me. So I thought, look, okay, I didn't have necessarily the terrible experience with the BA, but I just thought, look, I was really starting to get into the courses, and that's where around 2017, I went to the Steve McKnight Millionaire Mega Conference, met Joe, the other half of Oz Property. And that to me really that's where I invested in some more of my own education and sort of dropped some money on a course there. But I decided to go almost sort of go alone for the second one, and just have some sort of resources on the ground to be able to help me out. And it was only a couple of hours away from me anyway, so I could, if I really needed to, I could drive there. I didn't do too many trips. I just jumped up there and had a bit of a look around. But yeah, it was pretty comfortable with the dynamics and just the buying price as well. Like my eyes were really opened, whereas before, I suppose when you give a brief and you say, "Well, buy me anywhere," they put you in put you in a location where they do their best to map you out to your strategy and what your brief is.
Yeah, absolutely. Well, you've thrown out some terms, guarantor loan, LMI. The listeners may not know what it is. Obviously, if we start to go through all that, we probably won't have enough time for the podcast. But do you want to just give a really, quick snapshot of what a guarantor
Yeah,
loan
so
is?
guarantor is if one of your parents, and they've even extended out to family, so where they have equity in a property, preferably investment property, doesn't have to be. You can if you have the borrowing capacity, you can then enable to get yourself into 100% lend, which you're 100% plus actually. So you can say, "Oh, look, that sounds really risky, doesn't it?" You're putting so it's not something you should be taken lightly, and it's a very regulated. The parents or the guarantor needs to seek separate individual legal advice. So I would want to see people have a bit of savings sort of history. So if somebody just coming to you and they're spending all their own paycheck to paycheck, probably not the person, and not everybody's going to be eligible for that. So lender's mortgage insurance, it actually protects the lender. So you need to be really cognizant of that. You're paying essentially that if you default on the loan, the lender can recoup those sort of, they go for insurance. And then if they don't recoup their funds, they can then sort of, the insurer can potentially come after you as well. So just look, it's rare, very rare, because mostly property is an on and upward trajectory, but you just need to be kind of mindful and cognizant of both of those sort of things. So the guarantor is an option, maybe an option for some people, but you really have to take that very seriously. And then what happens is, over time, you can release that guarantor from the loan. So preferably you're going to buy in a market that's going to grow, and then release that guarantor once it gets to an 80% loan to value ratio as well. So make sure you're doing that
Yeah,
as well.
I think
Protecting it.
it's a great initiative. I think just like you said, you've got to be extremely careful. And one thing I would point out, because we are helping guarantor clients at the moment who are using
Yeah.
guarantor loans, and those clients are typically people who can't actually get a loan, and so
Yeah.
therefore their cash flow may not be as strong. And so when you borrow 100% of a loan, and
Yep.
especially in these days with the rate environments, you've got to be
Yeah.
extremely careful that you can cover your cash flow, because
Yeah.
at the end of the day, if you start buying in very low yielding areas on a 100% loan and you're on your own and
Mm.
you're not getting other assistance, but you can get that loan, you may not be able to sustain that portfolio because it's such a
Okay.
high loan, essentially, right? You're not putting
Yeah.
a deposit down, so like on a 100% loan. So yeah, you've got to be very careful about where you buy, what you buy, not just making sure there's growth. You've got to consider the cash flow as well. So that's a
Very
tip out there.
Very refreshing to hear, man, because yeah, a lot of people talk for these terms, unlimited borrowing capacity and all that, and guarantor. It's just like, oh yeah, just go and get into the market. But yeah, you need to consider the risk and the implications of what you're doing. You're potentially taking on $500,000 worth of debt here with somebody, your parents. You never want to put anybody, your loved ones, in that sort of situation. So yeah, very wise words.
Okay, now number three, where are we?
So I took a bit of a break. So and this, yeah, So as at that stage, I was doing a bit of traveling. I spent 5 months in Africa. Because we're at the stage where we can. So when traveled overseas, I went. That's a story for another podcast. But so next one, so I did that education, and I was actually then I did a couple of developments down in Adelaide. And you say, well, how the heck did you learn how to do developments? How did you get comfortable with that? So I won't tell you the full or every single detail of those developments, because that's a 50-minute podcast itself. But what I will tell you is, so I did 2 development deals. With the first one, we sort of I did a joint venture, contributed some borrowing capacity, was able to have, this was 2019. So just around the time, so I did a couple around that and was able to pull out sort of with the joint venture around that couple $100,000, because I was getting quite strapped with the borrowing capacity. So what I then did was, I thought that first one went pretty well. Let's do it again. And of course, so we entered that around mid 2019. And then what we did was it was a place where we could build, knock down the existing dwelling, and in the Port Adelaide, it was Semaphore, sort of Woodville area. and those who know Port Adelaide's, it is a very working class area. So we did that there, and look, we bought that the dwelling there for 460. It was on, I believe, just under 1,000 square meters. So we could build 4 row dwellings. There was a quirk in the frontage was significant, so build those in, have the drive at the back. So what I said to the joint venture, because I wanted to retain some of these dwellings, so I could really start to see, so I said, hey, look, I want to buy out 2 of these properties. So I bought out 2 of those, and then I was able to finance that with some of the cash, but also the borrowing capacity I had there. So look, they were sort of that low 400s once they were built. They were worth that. So I was able to finance that. And look, at the end, they were renting, I've just got them here, they were renting for 450 and 430 each. So pretty good yields, great depreciation. I'm not saying people should invest for that reason. And that was some of the challenge they were financing, because we were starting to break ground at the middle of, at the start of COVID. Like, we were going for bank finance in April and May of 2020. So I wouldn't, it was interesting to be able to we got that across the line with some private funding eventually. So look, this is more creative. So look, there are ways that you don't need to go down that path, but I was getting itchy feet, and there was a PPOR on the horizon. So I said, okay, I've got a bit of borrowing capacity. I needed to and that sort of builds out the portfolio, so to speak. So
Yeah,
those did extreme. Sorry, Gamer.
I was just going to say, very, very brave at that point in time. But if I could summarize a few things, number one, fantastic timing to get into Adelaide and buy that property for that much. Number two, you've got a couple of properties, but you don't have 6 or 7 properties where you're highly in debt and to take on loans like this. So in hindsight, you've done very well in that respect. And construction costs. I mean, I'm sure, as you know, you may have, I don't know if you experienced it through the COVID period, but at that point in time, at least when you're trying to source builders, it wasn't as bad as what it's been over the last few years. I would
Do you
assume.
want me to tell you what the build costs on these little row? And yeah, we had good relationships, but we built those dwellings for 200,000 each. Which this was because we entered into fixed price, and luckily they were advanced enough in that building, because they were at the stage they didn't have to come to us, because I've heard so many stories of people, even when they had fixed price builds, they had to come and say, look, we just can't continue to build these at that cost. We're going to have to, it's up to you. We're either going to go bankrupt, or we're going to have to renegotiate those fixed price builds. So we were very lucky that we did that around June of 2019. So locked them in, and they sort of started to break ground around that, sort of just as COVID was kicking off. We didn't stuff around with the finance. We said, okay, look, it's not ideal, but we just have to make it happen. We tipped enough finance into the deal. So the total development cost was just shy of that $1 million. So you think to build 4 dwellings, the purchase price, and so we tipped in a little bit of cash into that, financed it with sort of that south of $1 million. So, and then was lucky to come
double
out.
now.
Yeah. So they were.
Oh, sorry. No, I'm talking about the construction costs. If you're gonna,
yeah, definitely. Yeah, you're not getting away. Even for those, look, if you're really a volume sort of developer, you could probably do it for maybe 380, 400. If you're building anything like medium to high spec, sorry, I'm throwing out terms, but you're looking at that 450 to 500, even in Adelaide, because it's just not, it's not profitable. I was speaking to a builder yesterday down the south, and he's going to build some of his own. He could probably knock something up for 450, 500, but that's him doing all the work and taking no profit from that deal. So yeah, it's a harder strategy to replicate today. But it's sort of, and people say, well, you can't buy $300,000 properties today, or you can, but it's probably not in markets where, so that's one of the insights I'll share at the end as well. But.
Yeah, absolutely. No, look, there's many questions I've got about the development, how you tackled the approval process and subcontractors and any lessons learned with that. So obviously you've built these, we can get that on another pod. So what's the end result, in terms of value and where is it sitting now?
So where we're sitting, excluding, and people are like, oh, you don't, this is built over 10 years. So excluding PPR, we're sitting roughly at about that $2.8 million. PPR, it's a little bit more than that. And the debt on that is just a touch over 1.6 million. So we're sitting just under that 60% LVR. The reason being is because I have extracted equity as we've gone along. The thing that really helped that is the rents on those properties down in Adelaide. And my original rents, so they're now renting for $660 and $650 each. So if we look at, just
Wow.
to give some more numbers, so the gross current rent, like this might sound impressive, but I'll give you the loan numbers, and it won't necessarily be as impressive. So at the moment, it's just over $120,000 gross cash flow, which is only a rental return on current price of about just over 4% gross yield. So but if you do it on purchase price, which is that controversial, do you do it on yield price? It's just over 8%. So one of those is at the Newcastle one's at 10% on purchase price. But I think you should, yeah, and we could have the argument to the so the loans on it is still, we're roughly sitting at about that 80K just in loan interest as well. So it's sort of, yeah, depending on the costs, give or take, and some of the one is principal and interest. We're looking at sort of, we're a little bit
40.
positive. So and you
Yeah.
sort of say, so it's taken me 10 years to get to this. Get to this stage. And of course, I could have gone a bit harder, but I decided to sort of travel, and I've been putting some money into the Oz property portfolio, which is another story. But so, and I did this all on less than 150K income, and I haven't, even in my business now, I haven't earned over the 150K yet. So I wanted to put the message out there to people that it can still be done. Can you do it with the same sort of properties I did with? Probably not in the same locations. Not likely. But it's just, well, anyway, that's kind of the portfolio. But any question on that, let me know.
No, that's amazing, mate. I mean, look, like you said, you pump money elsewhere. You've got a very impressive portfolio
Yeah.
where, there's not many that are positively geared at the moment,
No,
with
it's hard.
rates. Yeah. So once that rate, the rates come down,
Yeah.
hopefully the portfolio will do it, run itself. And, once you start paying off the principal and all that kind of thing, I think you're in a very, very good position. And at the end of the day, from my perspective, it's all about lifestyle, because for me,
Mm.
it's not about the portfolio size as such. Obviously, that gives you more options the higher you go with the less debt, but it's also, it has to be combined with your lifestyle. And
Yeah.
like you said probably before, you're talking about Mr. Money Mustache and all that. I'm sure you still, have those same sentiments where you don't need, this lavish lifestyle. And it sounds like your portfolio over time, if you don't do anything to it,
Yeah.
it's probably gonna, with your rents increasing, you're probably gonna not need much more.
Yeah, the one I'm most excited about is that Newcastle one, because you sort of start to see people where the affordable markets are. The Zilmi one, I'm not like, it's at almost close to double now, very quickly, very recently. The Adelaide ones, they'll sort of tick along, do their thing. But yeah, that's kind of exactly my thoughts as well. And yes, I could probably, after capital gains, sort of pull out that 600-700, maybe, not financial advice. Go and speak to your accountant. Yeah, so I could go and do that, but then, okay, and I could reinvest that. So I sort of, it gives you the options, and it gives you the ability to, and I have income coming in from other sources. So I do have some grand ambitions for it, because I've got a bit of an urge, a bit of an itch, as to whether to allocate some money. But that's yeah, it's exciting what it'll look like next.
Yeah, I think it's a good lesson for everyone. It's not about the numbers and your properties, like number of properties you've got. It's
Yeah.
what it's doing, what the cash flow is going to bring at the end of the day, what's the exit strategy, and what sort of goals you're trying to get. So I think
Yeah.
that's a really good point that you've made. So final steps. Do you have any? You're talking about itchy feet. Have you got any ambitions at the moment to get any more?
Yeah, definitely. 100%. I'm on the hunt. As somebody who's very active in the market, and helping people out as well, and just having those conversations. For me, the next will likely be, and it'll come down to the equity available, and extracting that. I'd love to get potentially a unit block and/or maybe commercial. We'll sort of see where that plays. But I'm toying up with saying, we're putting something little bit more with the Melbourne. We've got a lot of exposure there in a separate portfolio to the one that we've got 4 deals there already, if you include Geelong in that. So I'm sort of on the fence as whether I want to continue to expose myself to the Melbourne market, and I've got exposure across those 4 states already. So maybe it depends on, do I want to go up to a more speculative market of Darwin? And I'm not suggesting people should go there, but just for full transparency, I'd have to really, I've understood the market a little bit, in terms of, yes, there are some big investor drivers up there. So those are sort of thoughts of whether I'm thinking, do I want to buy another property in Melbourne, or it's only in my name, or do I want to move to a unit block or commercial? That's kind of the questions, and it'll likely be in the next 1 to 2 years. Look, it just comes down to the purchase price as well. I'll probably be aiming for around that sort of 800K to a million. If it's north up in Darwin, maybe a lot less, I would say. But yeah, those are kind of conversations, considerations I'm thinking of in the next couple of years. And then getting to the stage, look, I want to have sort of at least that 200K passive income and maybe a touch more than that. So I want to do that by the time, yeah, let's say next 5 or 10 years, that'll start to transition across to that. And we can sort of pull some levers, maybe sell a property or two, and then really redistribute some of that capital as well.
Yeah, I think that's a great summary. I mean, you've highlighted that the portfolio you've got, the numbers that's running at the moment. It sounds like you're going to need a bit more sort of growth or cash flow properties, at least down the back end, to get that 200K goal. But that's pretty exciting, mate. You're off to a great start, no doubt. There's a couple of people I know who'd love to help you on the commercial side, Mr. Polisi for one. But yeah, but no, that sounds great, mate. And that's a good segue with this borrowing capacity and all that. Now you've started a new venture. Do you want to tell us a little bit about that and how that's maybe impacting your borrowing capacity in the next few years?
Yeah, so it's actually, I mean, I've got other income sources, but at the
Yep.
same time, yeah. So I've started Step Up Loans, mortgage broking, and for me, the reason why I started this is because I was a broker 6 or 7 years ago, and I do love the numbers. I love unpacking it. Should see my spreadsheets. I'm a bit of a spreadsheet enthusiast, you could say, and for me, I love to prepare. But for me, it's about and the conversations I've been having over the past couple of sort of weeks of this venture, there is a real need in the market to start to plan out in advance, that sort of thinking a couple of steps ahead, because the investors, once you get to that two property portfolio, you start to become really hard for some mortgage brokers, and for that sort of, because it's like, okay, I could go and write this $800,000 loan over here for this first time investor or first home buyer. It's that's a loan, and that's probably that pays me more money for this $500,000 investor loan. But for me, I love to help people and see people grow to get that strategic information and advice, and that's what we've been doing in Oz Property for the last 5 years. So for me, I only want to really work with, at this stage, at least for the year, and I don't foresee it changing all that much. 50 to 100 investors, and once I sort of hit that, around that, sort of get to that cap, I really want to have in-depth conversations and really have go deep with people. So, and yes, am I leaving some money on the table? Maybe yes, but to me, there needs to be that information there for investors to be able to not necessarily hold their hand. If they need that network, if they need that accountant, the buyer's agent, I love to see people do it themselves, but buyer's agents are definitely a fantastic resource. Yeah, so that's why I started it, and that's my interest in finance. Because finance, if you don't get that, you need to be able to go to the next level. You need to plan it out and map it out. So that's what I'm going to be doing for at least the next sort of, yeah, maybe next decade. Who knows? We'll see
Yeah.
what life throws at me.
Couldn't agree more. I mean, the amount of people that come to me going, Ika, where's the best location? I'm like, we need to talk about your finance. That is what sets the absolute base of how we can actually optimize your portfolio. And that comes to brokers, at the end of the day. And you've got obviously the experience in the back end. I can tell you've got your spreadsheet on the side there as well with your own portfolio. So no doubt you love your spreadsheets, but I think that just shows your analytical nature and the love for numbers. So I think you're in the right field, mate. And look, no doubt you're going to do fantastic either way through your brokering firm. And, I can sense the passion in that, and also your own portfolio. So I think there's some real nuggets in that whole story, mate. I really appreciate it. Do you want to share anything before we knock off?
No, I just wanted to say for those, because starting off today, there's so much noise out there in the forums, even our forum. Like, as much as you can really sort of unpack, because it took me three issues to get into my first deal. So if you're struggling to get to that, just, yes, create your couple of sort of next actionable steps. As in, okay, find out the borrowing capacity. Once you've got that, okay, great. And then sort of plan a couple of properties ahead. Great. Okay, then go to, okay, where does my budget allow me to buy? And then pick 3 or 5 suburbs. And then if you're going to do it yourself, that's great. If you're going to use a buyer's agent, even then, sort of have some questions prepared to understand and really be clear on, and it's going to change, but if it's 100K now, probably most likely 150K, figure out what that, and reverse engineer that, and have those conversations on, okay, how does this next purchase help me move closer to that goal? And if you're not sure on why it's doing that, or why that area, and where that sort of is within the portfolio, then just kind of ask yourself the 5 whys, like, or why is this property, like, or how is this property? And if you're going to a broker or buyer's agent or whoever it is, and they're telling you, oh, look, sorry, we can't help you now. I'll ask some more questions. Say, how can I get to that next? What do I need to do to buy that next property? What does it need to look like? Don't take no for an answer, people, because if you just, I've even done that. I've had to sort of recalibrate and restructure. So that's what I wanted to say. Yeah, and just kind of reach out to people as well, because you just never know where that door is going to lead you. And I was going to say a little challenge to you, Anka, as well. I want to see you get to at least 100 podcasts on this, because if you get to 110, maybe I can come back on as number 110, given this is your 10th. I won't be the 100th. The 100th will be a celebration, but 110, if you get there, I'd love to come back on.
Oh, look, mate,
If you haven't.
I'd love to do it. I mean, at the end of the day, I don't even think of it as a podcast anymore. I just have a conversation and learn so much from guests and vice versa. And I'd love to get there, but no doubt if I can get great guests like you, I'm sure we'll add a lot of value to everyone. So
Give him a 5-star as well. Give him that 5-star. It does really help. It motivates you to keep on going. So,
yeah,
and thanks, really appreciate you having me and the resources that you have available, and just what you're doing in the industry. Like you're not out there you're out there similar to myself to go and genuinely help investors. So thanks for having me.
absolutely, mate. No, thank you for coming on, mate. I know you're a busy man and you've got a lot of things going on. So I really appreciate it, and we'll hope to have you on soon. Thanks a lot.
Thanks, everybody. See ya.
Thanks everyone for tuning in. I'm sure you'll get a lot out of that one. So tune in for the next one and we'll catch you all soon. Hey guys, thanks for tuning in. If you enjoyed the chat, feel free to drop us a rating on Spotify or wherever you listen. It helps us reach more listeners to help them with their journey. Catch you in the next episode.